Good evening, everyone. Welcome back to the online live class from ICI. How are you all? I hope you all are doing good and working really hard for the upcoming exams and going through the subjects, the topics, revising things, recovering some of the things which you haven't done. So I hope all of you are doing good right as of now. Yep. Good evening, everyone. Good evening, Jaspreet. Good evening, Priyanka. Good evening, Nanesh, Nipun, Jash, Vedika, Alok. Okay. Good evening, everyone. So let's get started with another lecture of this interesting subject of financial management. We'll be taking up the topic, as you can see on the screen, the topic of ratio analysis. Okay, so we are going to look at the topic of ratio analysis for today, as well as the next session that we have on Saturday, I presume. Okay. So let's get started with the topic without wasting much of our time. So to begin with, I would like to start the session with a question as to, can you guys tell me what all things are you going to consider before you make an investment into a company, or before you go for buying the shares of a company, or before you are you are thinking of joining any business entity as a partner, right? So what all factors are you going to consider before you actually make an investment into a typical company? Yeah. What all factors can we consider, guys? Yeah. So someone, Vinay, is saying that, sir, it should be return on investment. Okay. So as per Vinay, it's return on investment. Okay. Then anyone else? Anyone else, guys? What all factors are we really going to consider before making an investment? Return on investment, then, okay, growth prospects. Okay, growth prospects. Nipun is saying growth prospects. Then Alok is pointing out, sir, it should be EPS, net profit. Okay, value of company. Okay, value of company. Then debt equity ratio, gross profit. Okay, we have the numbers as gross profit, profitability, quite impressive. Okay, profitability, market price, risk. Okay, past performance. Okay, dividend payment track record. Perfect. Debt equity ratio. Okay, fine. So these are this whatever I have restated. That's on the basis of your responses. Now, if we consider investment in any typical company, we are primarily going to consider four major areas. Now, these four major areas can be sub-classified into further multiple, further multiple numbers or further multiple aspects. But the four major areas that we should be looking at when we are talking of investment in any company, it's typically going to be the first and foremost that we are going to consider is profitability. Profitability. Then, second thing that we are going to say is, what do we mean by the liquidity? And even in that case, liquidity, we are going to look for long term and short term, long term as well as short term. Third thing that we can look for is efficiency, as to how efficiently the business is being conducted, efficiency, or what is the level of activity which the business undertakes, right? Then the next area which we are definitely going to cover up is return on investment. So these are the primary four areas which we are going to consider: profitability, liquidity, activity, efficiency. Okay, and but obvious return on investments also. Okay, so the first thing that we have is profitability or liquidity, whatever these aspects that we need to consider. The question arises, sir, how do we really get to know what are these, or how do we measure these aspects? How do we measure the profitability? How do we measure the liquidity? How do we measure the efficiency, activity, returns on investment? How are we going to measure them, right? So the next question obviously follows, sir, how are we going to measure them? So how do I answer this? How? Now, of course, without any second thought, we can say, sir, we are definitely going to measure them with certain numbers, right? With certain numbers, possibly ratios. We're going to measure them by certain numbers, right? Or by certain ratios, or by certain percentages. Okay. So, and our task in this chapter, in this chapter, our task is to calculate these ratios and have an interpretation of these numbers, right? So we are going to look at how do we calculate these ratios, numbers, percentages, and how do we interpret them. Okay. So this chapter is going to be like providing you some parameters or measures to actually have a look at financial health of the company, right? So whenever you go to a doctor, he will just not be looking at your face and say that, okay, you are sick and you need to, you're sick and you need to be, treated in so and so way. So he's just not going to look at your face, or he's just not going to look at your hairstyle, right? And say that, okay, you are ill. That's not possible. So how does a doctor determine what illness you have got? How does a doctor determine that what is the illness that you have got, or I can say what medicine should be provided to you, what treatment should be provided to you? Can I say doctor asks for some of the reports? If not reports, at least the doctor asks for some basic things like your body temperature, like your blood pressure, like your sugar level in the blood. So all these are numbers basically, right? Body temperature is a number. The blood pressure level is a number, right? So all this uh, health analysis, the physical health analysis of the body undertaken by the doctor is through numbers. Similarly, when we want to undertake the financial health analysis of the company, I do need numbers for analysis, and those numbers are these set of ratios or percentages, right? Those numbers are these set of percentages or the ratios that we are going to calculate. In today's session, we are going to be going through a lot of ratios with logic, and I'll make sure that you need not by heart any of the ratios, because we need to understand the ratios very clearly. Okay, we need to understand the ratios very intuitively and with great detailing and logic, so that you never forget these ratios. Rather, you should not be mugging up the ratio, you should be understanding the ratios in a quite logical manner. Okay, guys. So now, what are the various types of ratios that we have to talk of? Ratios, in case of ratios, we have got the ratios into primarily into four categories. The first category is the liquidity ratio. First category is liquidity ratio. Okay. Liquidity ratios. Then the next thing that we have is leverage ratios. Leverage ratio. Okay. Then the fourth category of ratios that we have is activity ratios. Okay. Now, each of these areas of our ratios, we are going to deal them in detail. So be rest assured that these are just the types of ratios that we are going through. Then we have profitability ratio. Profitability ratios. Okay. Yeah. By the way, this liquidity ratios are also actually said as, they're also called out as short-term solvency ratio. Okay. These are also said to be short-term solvency ratio. And these leverage ratios are also called as long-term solvency ratios. Okay, leverage ratios that we are going through are called as long-term solvency ratios. Okay. Then activity ratios are also a measure of efficiency ratio. They are also a measure of efficiency. They're also a measure of efficiency. And these profitability ratios are sometimes also called as return ratio. Okay. So these are the broad category of ratios that we have got. Okay. So we are going to go through each of these types of ratios in detail with an intuitive understanding. I'll make sure that you understand each of the ratios in a intuitive way. Okay. Um, so let's just begin with it. Let's consider three companies, guys. Let's consider three companies, X, Y, and Z. Now, if we consider current assets of X, it's let's say 10 lakh. Okay. And current liability is let's say 5 lakh. Current assets is 10 lakh. Current liabilities is 5 lakh. What will be the current, uh, what will be the net current assets? What will be the net current assets, guys? Of course, it's going to be 5 lakh, right? It's going to be 5 lakh. Okay, so this is our net current assets. Net current assets, 5 lakh. There's another company Y, which has got a current asset level of, let's say, 1 crore. Current asset level of 1 crore. Can you tell me, compared to X, is the company Y more solvent, or is the company Y having more liquidity? Can you say that compared to X, Y is having a greater degree of liquidity or greater degree of solvency as its current asset level is 1 crore? Can we say that? Can we say that, guys? No, we can't. Why? Because, sir, you have not stated the current liabilities, right? So let's say I'm stating that current liability is 95 lakh. Current liability is 95 lakh. And now, if I tell you, so net current asset for Y Limited, net current assets for Y lakh, it comes out to be 5 lakh, right? So Y Limited, current assets 1 crore, current liability 95 lakh. So we have a net current assets of 5 lakh. So do you mean to say that X Limited and Y Limited are having the same level of short-term solvency? Are they having the same level of short-term solvency? Are they having the same level of short-term solvency as the net current assets is one and the same? No, you cannot. In terms of liquidity, you cannot say that X Limited and Y Limited are having, are having the same amount of, liquidity. Like for example, if I tell you Z Limited has got a current assets to the extent of 10 crores. 10 crores current assets, and it has a current liability of, let's say, 9 crore 95 lakh. 9 crore 95 lakh. Right? So what will be the amount of net current assets? What will be the amount of net current assets? That's going to be 5 lakh, right? Net current assets is 5 lakh. So now if I ask you, which company is better in terms of liquidity? Can you say all three companies are having the same level of liquidity? No, you can't, because, sir, even though net current assets or working capital level is constant for all the three companies, that's 5 lakh, 5 lakh, 5 lakh. But what we need to look at is the ratio between current asset and current liability. We need to look at the ratio between current assets and current liability. So if I ask you, what is a current ratio? Sir, what is a current ratio? That's simply current assets divided by current liabilities. Current assets divided by current liabilities. So current ratio is current assets divided by current liabilities. And if we calculate the current ratio over here, what will be the current ratio numbers? For X Limited, it is 10 lakh divided by 5 lakh. That's equal to 10 lakh divided by 5 lakh. So current ratio comes out to be 2:1. Correct? Then for Y Limited, current ratio is how much? 1 crore divided by, if you do the division, 1 crore divided by 95 lakh, you'll find that it's 1.05:1. Okay. Then for Z Limited, you'll find that it's 1.005:1. 1.005:1. That's the current ratio number. So now if I ask you, which company is having a better stability in terms of short-term liquidity, it's obviously, guys, company X, because of the current ratio being 2:1. So if I ask you what's the interpretation of this 2:1, can I say it means for every 1 rupee of current liability, for every 1 rupee of current liability, company has 2 rupee of current asset. For every 1 rupee of current liability, company has 2 rupee of current asset, right? Whereas over here, we can say that the company has, for every 1 rupee current liability, it has got only 1.05 rupee as current asset. And in this case, even it is much lower. So what's the thumb rule that we can have Can I say higher the current ratio, better it is? Higher the current ratio, better it is, or better stability, better liquidity it provides. Because for paying current liability, we need current assets. So for every 1 rupee of current liability, if you have higher amount of current asset, it indicates a greater degree of liquidity. Okay, it indicates a greater degree of liquidity. So now if I tell you, let's say there are three companies, A, B, and C. Let's say there are three companies, A, B, and C. And the current ratio of those companies, current ratio of those companies are, let's say company A has got a current ratio of 2 is to 1. It's really good, sir. For every 1 rupee current liability, there is 2 rupee current assets. So our current assets is basically double of current liability. So it's a good thing. Okay. Company B has got a current ratio of 3 is to 1. So then this is much better, no? This is much better because it provides even more security, even more stability or liquidity. But whereas in C, let's say it is 10 is to 1. What does this 10 is to 1 mean? It means for every 1 rupee of current liability, you have only 10 rupee of current assets. So for 1 rupee of current liability, you have got 10 rupee of current asset. It means your current asset is 10 times of current liability. So does it seem to be a bit problematic for you guys? So having so much current asset, is it really going to serve our purpose? First of all, let's try to understand, sir, how come this current ratio is so high? How come this current ratio so high? Can you tell me what could be the reasons for this current ratio being so high? What could be the reasons for this current ratio being so high? Can I say it's possible that company has got a greater degree of cash? Company has got a greater degree of cash. It's possible that company has got possibly a greater degree of debtors, or it's also possible that company has got a greater degree of stock. Now, each of these three scenarios, higher cash or higher debtors or higher stock, what does it indicate? What does that really indicate? What is that really indicating? Sir, high cash, high degree of cash. What does that mean? It means that the company is having a great amount of cash available with it without any area in which it can, spend it or it can invest it. So it is possibly not finding out the area where the cash can be invested. So company is actually falling short of the investment areas, or I can say company is not having much enough profitable projects, or it may be higher level of debtors. It may be higher level of debtors. When you say it's higher level of debtors, it means like company has got uh, a policy in which debtors are basically not paying money to the company. Debtors are actually not paying money to the company, and therefore a lot of money is tied up with the debtors. Debtors are keeping the money of the company, and they're doing their own business, and company is falling short of funds, right? And obviously, sir, if the company is having a higher degree of stock, if company is having a higher degree of stock, that means company is not able to sell its stock. So it means if you are having a high current ratio, it actually indicates inefficiency. High current ratio indicates high inefficiency. High inefficiency in a sense, uh, high cash, it means you're not finding much investment, the investment inefficiency. High level of debtors means uh, inefficiency in collection. High level of stock means inefficiency in selling the products. Correct? Yeah. So then the question arises, sir, what should be uh, the optimum level of current ratio wherein we can say that, okay, it is good enough. That is, this level of current ratio is good enough. So for that, let's look at some of the important points. The first thing that we have is we have understood that high current ratio. One second. Yeah. You have understood that? Hmm. High current ratio, it means better liquidity, right? It means better liquidity. However, if it is very high current ratio, it is very high current ratio, what does that indicate? If it's very high current ratio, it indicates inefficiency. It indicates inefficiency. Inefficiency with regards to what? It indicates inefficiency with regards to selling, right? It indicates again inefficiency with regards to obviously if you are having high stock, it means you are inefficient in terms of sales, right? Or you are inefficient in terms of collection, or you are inefficient in terms of investment. Correct. So very high current ratio indicates high level of inefficiency in terms of sales, collection, and investment. So, sir, you didn't answer us what's the ideal current ratio. So, whenever we talk of ideal current ratio that we follow is a ratio of 2 is to 1. So, ideal current ratio is 2 is to 1. Okay. So, we said that very high current ratio is not good because that indicates inefficiency. So, sir, I need to have some standard. So, the standard is ideal current ratio of 2 is to 1. Okay, guys? Fine. Okay. Yanesh, need not worry. After today's and Saturday's class, I'll be uploading this PDF on the portal. You need not worry. Okay. Let's go in depth now. Let's go into detail. Uh, See, we have a typical company in which cash is 10,000, bank is 50,000, short-term investments is 40,000, debtors is 30,000, stock is 1 lakh, prepaid expenses is 70,000, and the company has a creditor of 1 lakh 50,000. Now, creditor one fine day comes and asks for money. Creditor comes and it asks for money. Now, how are we going to make payment to creditor? How are we going to make payment to creditor? Yeah. Can I say when the creditor asks for money, first up, we will utilize the cash balance and bank balance. So we'll make payment to creditor with cash and bank. Okay. So with cash, we are going to pay 10,000. With bank, we are going to pay 50,000. So what we are left out is 90,000. Okay. Now, still the creditor's demands are not fulfilled. So what can we do now? Can the creditor just go away? No, creditor will sue me for the payment, right? So I need to do some sort of arrangement. So now that sort of arrangement will be right. So the only thing that we have right now is to utilize this short-term investments. So let's utilize this short-term investment and pay to our creditor. Let's utilize this short-term investment and pay to our creditor. So we have utilized the short-term investment for payment to creditor. So we still have a shortage of 50,000. So now what can I use? Can I use the debtors? Basically, sir, I cannot give my debtors to the creditors and ask them to collect it from them. But one thing we can surely do about debtors is possibly get them converted to bills receivable and get those bills receivable discounted. Now, sir, after the bills receivable discounting, we are going to get not the entire 30,000. Let us assume we are able to encash 29,000. It means still the creditors have an outstanding of 21,000. creditors are still having an outstanding of 21,000. It means it's a clear scenario, sir, that even if you are having the ratio as 2:1, even if you are having this ratio as 2:1, it was like 3 lakh is to 1 lakh 50,000. Right? Still, our current ratio over here, it was 2:1. Current ratio over here was 2:1, and still we were not able to fulfill the claims of the creditors. So there is a falling short. We are falling short of the funds. So where's the problem lying? So you said that ideal ratio should be 2:1. So in spite of having 2:1, we are still having a problem, right? So uh, if you're still having a problem, it means there is some shortcoming in this current ratio. And you know what's the shortcoming? The shortcoming is that in current ratio, we actually considered two such assets, which I cannot realize it so early. That is your stock and prepaid expense. So we could have given stock to the creditor. Na? The creditor will kick you back because he would say, why the hell did you buy the stock from me if you just wanted to return it to me? Right. So, of course, you cannot give stock to your creditors back, and neither you can encash your prepaid expenses. Like if you would have prepaid your insurance expenses, or if you would have prepaid some of your dues of advertisement or some of prepaid salary, you cannot recover it back and then give it back to the creditor. That's not possible. So, for that reason, we state that stock and prepaid expense are not something, uh, capable of honoring the creditors. They're not capable of honoring the creditors. And for that reason, we need some ratio. We'll need some ratio which will actually take care of this shortcoming. And that ratio is quick ratio. That ratio is quick ratio, guys. Quick ratio, or that's actually called as acid test ratio also. That's also called as acid test ratio. Okay. Then what's the ratio about it, sir? Well, the ratio is simply, as the name says, quick assets upon current liabilities. Quick assets upon current liabilities. And when we talk of in detail, so what does that mean is, in quick assets, what is included in quick assets? It includes your current asset. From that, you reduce inventory, and from that, you reduce your prepaid expenses. Right? So, current assets minus inventory minus prepaid expenses. Okay? So, that's how we have this quick ratio numerator, and denominator without any saying, it goes as current liabilities. Okay, that's your quick ratio. So remember, in quick ratio, we are actually removing those assets, which cannot be utilized for settlement of the liabilities. We are actually removing those assets which are not useful for settlement of liabilities. Okay, so that's your quick ratio. Then we have this cash ratio, which is again more refined version of quick ratio. Cash ratio is a one step ahead, refined version of quick ratio. And this cash ratio is basically calculated, or it's also actually called as absolute liquid ratio. It's also called as absolute liquid ratio or absolute quick ratio, one and the same. And this absolute liquid ratio is simply calculated by taking only those assets which can be clearly used for settlement of liability without any loss in value. Like in this case, we actually bought the money by discounting the bills. Right? We bought the money by discounting the bills, and there we actually had a loss. So instead of considering those debtors also, we only consider three items, and that's called as cash plus bank plus marketable securities. Cash plus bank plus marketable securities. Okay. Or let me just call it as marketable securities. Cash plus bank plus marketable securities. And of course, dividing it by current liabilities. Okay. Of course, there's marketable securities. You can simply call them as cash plus bank plus short-term investment or current investments. Also, you can consider current investments. Okay. Current investment. And we can also say the numerator remains the same without say any fail. Numerator will be continue to be current. Numerator will be current liability as it is. Okay. Numerator will continue to be current liability. So that's your quick ratio number and cash ratio. So in quick ratio, we only consider, simply speaking, cash, bank, short-term investment, and debtors. But in cash ratio, it is even more refined. It's even more strict, wherein we remove the debtors and we only consider those assets which can actually be used to settle the current liabilities. Now, is there any ideal ratio for quick ratio and cash ratio? There's no such ideal ratio, but you can assume it to be like possibly for cash ratio. If you have it as 1:1, you are in a very safe situation for cash ratio, because whatever is the amount of current liability, if you have got that same amount in cash, bank, and very liquid assets, then you can easily get it converted and pay off your current liabilities. Okay, fine. I hope these three ratios are clear. We have done three ratios: current ratio, quick ratio, cash ratio. Okay. Let's look at another area which is prominent again. We find that in these ratios, whether our assets are enough to settle the liabilities. In these ratios, quick, current assets, and cash ratio, we look at the capability of the company, whether it is having sufficient amount of current assets or the typical liquid assets to settle the current liabilities. But one more thing we need to check is whether we have sufficient quick assets to meet the day-to-day expenses. Whether we have sufficient quick assets to make payment of the day-to-day expenses, right? Vedika is asking, in sale of short-term investment, there is a chance of loss. Then why we take into cash ratio? No, in case of short-term investment, we are saying the marketable securities, the securities which can be sold immediately in the market, which can be immediately sold in the market without much loss. Like you have those short-term government securities which you can sell it without much loss in its value. Okay, now, so here we are talking of how do we check if we have sufficient quick assets to meet the day-to-day expenses, right? So obviously, whatever day-to-day expenses we make, those are spent. Those day-to-day expenses are basically made from either you utilize your cash or utilize your bank balance or utilize some of the marketable securities, right? So we use these three things for day-to-day expenses, or you can say cash, bank, and marketable securities are basically used for settlement of your liability or meeting your day-to-day expenses, right? So you utilize them for daily operating expense. Now, how do we know that we are having sufficient balance or not? So for that, let's consider a simple example. Let's say your daily expenditure. Let's say your daily expenditure is rupees 100. You're having a daily expenditure of rupees 100, and you have got a balance in your wallet of rupees 1800. Can you tell me what is the number of days? What is the number of days for which? Uh, what is the number of days for which sufficient cash is available? For which sufficient cash is available? What is the number of days for which sufficient cash is available? Yeah. Can I say 18, right? So how do you get this 18? Sir, it's the balance that we have 1800 divided by 100 per day. You say that's like, 18 days is the time period for which we have the cash, or 18 days is the count of days for which we have sufficient cash. Now, something of that sort we have in this ratio. Something of that sort we have in this ratios. Now, what are these ratios, by the way? First one is basic defense interval ratio. Just like you computed this 18 as the cash balance that you have divided by expense per day, that's what we are going to talk of, this basic defense interval. Now, basic defense interval, in this case of basic defense interval, we have uh, cash plus bank plus net receivables. Cash, bank, and net receivables. Cash, bank plus net receivables plus marketable securities. Now, the point over here is we are looking for daily expenses. So why are we including net receivables over here, sir? Because net receivables are something which you will receive in future. So by the time you receive that money, you would be utilizing the cash, bank, and marketable securities. So daily expenses, it doesn't mean you have to spend it in one single day. It's going to be gradually being used, and by the time you get exhausted by cash, bank, and marketable securities, net receivables would have been realized. So of course, in the denominator, we would be having the operating expense. We would be having the operating expense per day, right? Just as you stated over here, in this case, 1800 upon 100. 1800 was the cash or the balance that you had, out of which 100 was being spent every day. The same funda we are using over here. This is what the level of funds we have: cash, bank, net receivable, marketable securities, and that is being divided by operating expense per day. Okay. And remember, the answer for this is always going to be in so many days. Just like you stated over here, 18 days being the number of days for which you have the cash balance. Same way, basic defense interval is also going to be a case in which you are going to say that there are so many days. Okay. So then the question arises, how do we compute this operating expense per day? How do we compute the operating expense per day? Operating expense per day is simply computed as your COGS, cost of goods sold, plus general admin expense, plus selling expenditure, minus any depreciation. COGS plus general admin expense plus selling expense minus depreciation. Okay. And of course, since we want it to be per day figure, it should be number of days in a year, right? So it should be the number of days in a year. So numerator over here, numerator is the full year figure. That is, in full year, whatever is your COGS, selling, general administration, and out of that, we divide it by number of days in a year. And why do we subtract this depreciation? Because in COGS, in general admin, in selling expense, you may have some depreciation expenses which you would have considered in that. But remember, depreciation is not a cash expense. You don't pay it in cash, right? It's just a book entry. So for that reason, we say that since it's a book entry, the depreciation amount needs to be subtracted from these three areas and divided it with the number of days in a year. Okay, and divided by the number of days in a year, so that you get what is your daily cash expense. And that daily cash expense is going to be the denominator in basic defense interval. Okay, so greater it is, remember, for basic defense interval, the greater it is, the better it is. Okay, so basic defense interval, we can state greater it is, better it is. Higher the basic defense interval, higher is the ability to bear all your day-to-day expenses. Okay, fine. So let's go for some other areas in which we are looking for the long-term solvency, because what we have considered over here is the short-term solvency area. Now we are going to look at some of the long-term solvency areas. Okay, so let's consider long-term solvency. Now suppose we are looking for three companies, P, Q, and R. Company P has got owned funds to the tune of 10 lakh. No borrowed funds. The total funds employed is 10 lakh. Company Q has got owned funds of 5 lakh and borrowed funds of 5 lakh. So total funds raised is 10 lakh. The other company R has got owned funds of 2 lakh, borrowed funds of 8 lakh. So we have a total funds of 10 lakh. Now remember, what are we talking of owned funds? Or owned funds means equity share capital plus preference share capital plus reserves minus fictitious assets. So it is equity share capital plus preference share capital plus reserves minus fictitious assets. And remember, this reserves minus fictitious asset is what we call it as net reserves. Okay. Now, of course, the investment that we look for, if you look at the balance sheet, the net amount invested will be same in all the three companies, irrespective of the level of debt. Okay, it's the same 10 lakh. Now, which company is actually stable in long term? If my question to you is, which company is stable in long run? In a long run, because remember, this borrowed funds and owned funds, these are all long-term funds. So these long-term, being considering these long-term funds, can you tell me which of these three companies are more stable or more liquid in or more solvent in a long-term nature? Can you tell me which one of them, P, Q, and R? Well, we need to compute some ratios, guys. We need to compute some ratios, and based on those ratios only, we can state which of these companies are basically more stable in long run. Okay, so let's try to look at some of the ratios, and then we'll come back to these companies and try to look into which ratio is more stable. So the first ratio that we have is proprietary ratio or equity ratio. Remember, this is going to be in percentage terms. Proprietary or equity ratio, this is going to be in percentage terms. So in equity ratio case, the numerator is shareholders' funds. Numerator is shareholders' funds. Denominator stands as net assets. Denominator is net assets. It means out of total assets. What do you mean by net assets, sir? What do you mean by shareholders fund? Let me clarify that. Shareholders fund means equity share capital plus preference share capital plus reserves minus fictitious assets. And what is net assets, sir? Net asset means your fixed asset plus current assets plus investment minus current liability. So we are basically talking of out of total assets, how much is shareholders funds? How much is shareholders funds in percentage terms? In percentage terms. Okay. So if we go ahead and compute the equity ratio or proprietary ratio over here, what will be the number? What will be the proprietary ratio over here for P, Q, and R? Proprietary ratio for P. Proprietary ratio for P will be 10 lakh divided by 10 lakh, which is 100%, right? For Q, it is 5 lakh divided by 10 lakh, which is 50%. And for R, it is 2 lakh divided by 10 lakh, which is 20%. So 100%, 50%, and 20% is the proprietary ratio. Can you tell me, looking at this number, which of these companies is more solvent in long term? Which of these companies is solvent in long term? In long term, solvency is obviously with P Limited, because you find 100% is a proprietary ratio. What does that mean? If 100% is a proprietary ratio, it means all its assets are basically funded by equity shareholders. There is no third party, there is no loan that is involved in this case. And for that reason, P is more solvent as per the proprietary ratio number, because 100% of its assets are financed by equity shareholders. So it is purely equity, purely owned company, no debt, and therefore it is having the highest degree of solvency and lowest degree of the risk. Now the next ratio that we have is debt ratio. By the way, this debt ratio means total debt, whatever is the loan that you have, upon net assets. You can also call it as, so this is 100% minus equity ratio. This is 100% minus equity ratio. Because this ratio tells you what proportion of your net assets is shareholders fund, and debt ratio, it says what proportion of your net assets is debt. So if you calculate the numbers, the debt ratio over here, let's see what does it come out to be. For the debt ratio, it is 0%. For P, for Q, it is 50%. Sir, how come you know it is 50%? So it's 5 lakh divided by 10 lakh. And for R, it is 8 lakh divided by 10 lakh, which is 80%. So tell me, which one of these three is having more stability? Of course, without any second thought, it is P, because it is having no debt, no loans. So if it's no loan, no debt, then we say if there is no loan, no debt, it's a safe scenario for company P. Right? Next ratio that we have for long-term solvency, again, it's called as debt equity ratio. Now, debt equity ratio, it means borrowed funds upon owned funds. So this is basically borrowed funds upon owned funds. So, sir, borrowed funds means it's actually short-term plus long-term debt upon owned funds will be equity share capital plus preference share capital plus reserves minus any sort of fictitious assets. short-term debt plus long-term debt upon equity share capital plus preference share capital plus reserves minus fictitious asset. And to have a interpretation of this number, we can say it means for every 1 rupee, for every 1 rupee of owned funds, how much is borrowed funds? How much is the borrowed funds? Okay. So if we calculate the debt equity ratio over here, the debt equity ratio for these companies, debt equity ratio 1. For Q, it is 5 lakh divided by 5 lakh. That is, by the way, debt equity over here will be 0. My bad. Because there is no debt involved in it. For P, there is no debt. So no debt upon 10. And then this is 5 lakh upon 5 lakh, which is 1:1. And then we have for R, it is 4:1 because we have 8 lakh debt and 2 lakh equity. So 8:2, which is 4:1. Now again, as per this criteria, higher the debt equity ratio, greater is the risk and lesser is the solvency. So if we just summarize all three ratios with regards to long-term solvency and risk. The equity ratio, if it is higher, it means your solvency is higher, risk is lower. In case of debt ratio, if it is higher, it means your solvency is lower and risk is higher. Debt equity ratio, if that debt equity ratio is higher, it means long-term solvency is lower and risk is higher. Okay, so that's the summary of three solvency ratios: long-term solvency ratio, equity ratio, debt ratio, and debt equity ratio. We still have one interesting ratio for understanding long-term solvency, and that's called as capital gearing ratio. That's called as capital gearing ratio. Okay, let's look at what is the capital gearing ratio now. Okay, so if I ask you what is capital gearing, let's understand it with the help of some numbers. Let's understand it with the help of some numbers. So for capital gearing, let's say we have three companies, P, Q, and R. The same as we have stated. P is a fully equity company, 10 lakh. Q is a company which has got 5 lakh owned funds and 5 lakh borrowed funds. R is a company which is having 2 lakh owned funds and 8 lakh borrowed funds. Total funds is 10 lakh. Okay. EBIT, earnings before interest and tax. Now tell me, is your earnings before interest and tax, whatever is your income before interest and tax, is that going to be different for different capital structure? Of course, no, because from wherever you raise the money, you actually earn before interest and tax whatever your business gives to you. So if you look at EBIT, then irrespective of wherever you get the funds, your EBIT is going to be a constant number. So let's say EBIT is 3 lakh in each of these scenario, whether you raise it by equity or by debt. Let's assume that all three companies are having same line of business. So EBIT will be generated on the same. Now interest for P, interest is nil because there is no debt. For Q, interest will be, let's say, borrowed funds at the rate of 10%. So if the borrowed funds are at the rate of 10%, 5 lakh into 10%, it means that works out to be 50,000, and the other area is 80,000. So profit before tax is 3 lakh. In the second case, it's 2 lakh 50,000. In the third case, that's 2 lakh 20,000. Taxes at the rate of 30%, it is 90,000, 75,000, and 66,000. PAT is 2 lakh 10,000. If you subtract over here, profit after tax becomes 1 lakh 75, and over here it's 1 lakh 54,000. Okay. So now if I ask you, which company has performed well? Is it P? Is it Q? Is it R? Which company has performed well? Can you answer me, guys? Which of these three companies have actually performed well? Is it P? Is it Q? Or is it R? Which of these three companies have performed well? Where would your vote be going to? Is it P, Q, or R? If you would say that, sir, it's the company P which has performed well because it has got a higher PAT. But remember, this PAT is earned by the company on entire investment of 10 lakh. On entire investment of 10 lakh. Whereas Q has earned 1 lakh 75,000 by raising just 5 lakh from equity, and R has earned 1 lakh 54 by raising just 2 lakh from equity. Okay, so we need to compare the performance of the companies in three areas. First of all, I need to calculate the return on capital employed, or return on capital employed, or it is ROCE. Return on capital employed, or ROCE. Return on capital employed, that's calculated as EBIT upon total capital employed into 100, which means whatever has your investment has gone into the business, on that investment, how much return are you earning? So by investing 10 lakh, the company has earned 3 lakh. P has earned 3 lakh. So that's the case with all the companies. Even Q has done the same thing. Q has invested 10 lakh and it has earned 3 lakh. R has invested 10 lakh and has earned 3 lakh. So return on capital employed over here, it's undoubtedly 3 lakh upon 10 lakh into 100, which works out to be 30%, which means all the three companies are into such line of business which give them 30% return. You invest 10 lakh and you get 3 lakh. That's the return on capital employed that we have. So invest 10 lakh and get 3 lakh. That's the return on capital employed which we have. But when it comes to what's the return that you have given for your owned fund providers or for your net worth, that's going to be a different number. So we'll talk of return on owned funds. Return on owned funds. Sir, what is the amount of return that the company has generated for its owned funds? So for owned funds, you see, in case of company P, the owned fund amount is 10 lakh. And the return earned for them is 2 lakh 10,000, right? So return earned for them, because this 2 lakh 10,000 is for whom? For the owned fund providers, for the equity shareholders. So for owned fund providers, we have this 2 lakh 10,000 upon 10 lakh. So for first case, by the way, formula will be profit after tax upon equity shareholders funds. The profit after tax for first company, it is 2 lakh 10,000 divided by 10 lakh, which is 21%, right? For next company, it is 1 lakh 75,000 on an investment of 5 lakh, right? So on an investment of 5 lakh, you have 1,75,000. So that works out to be 35% profit. For the third company, you'll find that it's 1,54,000 upon 5 lakh. Sorry, not upon 5 lakh. It is upon 2 lakh, 2 lakh being the own funds. So upon 2 lakh, which works out to be 77%. So without any second thought, which company has really performed well for its equity shareholders? It is this 77% company, which is company R. Now, the question arises, sir, all three companies are into the same line of business. All three companies are into the same line of business. Irrespective of that, the shareholders of R are having a greater return. Why is it so? We need to look at return on capital employed, which is simply the rate of return on business. So business is such that it provides you 30%, sir. But what's the rate of interest? What's the rate of interest? Rate of interest is borrowed funds rate of interest is 10%, right? So what is happening over here is you are having a business which gives you 30% return, whereas you have raised funds from market from the borrowed funds, which is costing you just 10%. So you are basically getting funds at 10% and investing funds at 30%. So the gap of 20% which you have, that goes to whom? That goes to ultimately the equity shareholder. Ultimately, equity shareholders are the gainers over here, and therefore we have this 35%, 77% return being given to Q and R. And that's where this concept is called as trading on equity. This concept is called as trading on equity. It means you get funds, you get the debt, you raise the debt at a lower cost, and you invest it at a higher rate. You raise the funds at a lower cost, which is 10%, you invested it at 30%, and therefore, by doing that, you're able to get a greater rate of return for R. It's pretty simple. You get the funds at 10%, invest it at 30%. So there is an extra gain that you have, and that gain goes to the equity shareholders. Okay. And this is what we call it as a capital gearing. Now, is this capital gearing always going to be beneficial for company R shareholders? Is it a case that always capital gearing will be beneficial and the company R is always going to get a higher rate of return on its investment, a higher rate of return for its shareholders? No. Remember the relation between these two numbers, the return on capital employed and the rate of interest. If your return on capital employed is higher than the rate of interest, if your return on capital employed is higher than the rate of interest, then only this is beneficial. If it happens opposite way, that the rate of return on business is lower and this is higher, things will swing and the company P will be a better company because you are getting funds. For example, let's say return on capital employed, it turns out to be just 10% and cost is, let's say, 15%. If that's the scenario, you would be saying, sir, I'm getting funds at 15%, but I'm able to invest it only 10%. Ultimately, I'm going to make a loss. Ultimately, it's the company which is going to make the loss. So gearing, or I can say taking loan and running the business, it is risky. And of course, it will provide you benefits if you have higher EBIT or higher return on capital. Now, where is this capital gearing coming in? Let me just explain this, where this word gearing has come from. I hope some of you guys might be knowing how to drive. I'm not talking of driving a scooty, right? But driving a geared bicycle or a geared car. So what would happen in that case? Suppose you are in the first gear, right? And you want to go at a speed of maybe 90 kilometer per hour. Is that possible? No, sir, that's definitely not possible, right? So if you want to go for a higher speed, you need to increase your gears also, right? So let's say you increase your gears and now you are in the fourth gear. Okay. And in the fourth gear, you're driving at a speed of, let's say, 80 kilometer per hour in fourth gear. Now, if you immediately drop the gear from fourth to first, what will happen to your car or what will happen to your vehicle? The vehicle or the engine will immediately stop. The vehicle or the engine is going to immediately stop, right? So they'll just stop because to maintain that speed, you need a high gear. You cannot be moving with a low gear at a higher speed. And neither it's possible that high gear with low speed. Okay. So gearing is that's where we have. So how does this concept come up over here? Remember the EBI2 that you generate is your speed and the amount of borrowed funds that you have, that's your gear. Okay. So here you have this ratio as 1:1, own funds to borrowed funds, own funds to borrowed funds, right? So in that case, you're having a bit of gearing. And over here, you have a high gear. So if you want to really gain out of it, your EBIT has to be really strong. If you are going at a very first gear, EBIT cannot be sufficient enough to provide you excess returns for your shareholders. Okay. And that's where capital gearing ratio comes in to measure the level of gear that you have in your business. And capital gearing ratio is calculated as preference share capital plus debt upon equity share capital plus reserves minus any sort of fictitious assets. Now, remember, preference share capital is also like a borrowed funds only because you need to pay a fixed amount of dividend to them. So when any such type of fund asks you for a fixed amount of dividend, that becomes like a problem for you because preference share capital, if it's having a fixed amount of dividend, then you are basically under a burden that you need to pay that much amount, right? So preference share capital and debt are together placed in the numerator in capital gearing ratio because these are the funds requiring, these are the funds requiring fixed rate of return, right? And of course, the equity share capital reserves, they don't require any fixed rate of return. Okay, so preference share capital plus debt, these are the funds which require fixed rate of return. Equity share capital plus reserves minus fictitious assets, that's the denominator, which do not require fixed rate of return. Okay, so Yufa is asking, is the goodwill an example of fictitious asset? Yes, you can say, or goodwill. Fictitious assets may include some miscellaneous expenditure not written off, any preliminary expense, not written off. So all those things are fictitious assets. So basically, the assets which are not assets, the assets which are not assets, that's your fictitious asset. Okay. I hope capital gearing concept is clear to everyone. Is the concept of capital gearing clear to everyone? Yeah, sure. Is the concept of capital gearing clear? Remember, capital gearing will be beneficial only if you're having a high gearing. If you're having a low gearing, then return on equity will suffer. Right? Return on equity is going to suffer. So I'll just explain it to you. I'll just take you an example. For that case, let's say uh, the same set of companies, if I consider the same set of companies over here, uh, or my bad, I'll just copy this portion maybe. Yeah. So P, Q, and R, the three companies. Now let's say the EBIT drops to just 90,000. earlier we had considered a EBIT figure of 3 lakh, right? So now we are saying, let's say EBIT is 90,000. If EBIT is 90,000, interest over here nil, and since it was at the rate of 10%, over here you have 50,000, over here you have 80,000, and profit before tax will be 90, 40, and 10. And tax rates are 27,000, 12,000, 3,000. Profit after taxes 63,000, 28,000, and 7,000, right? So if I ask you what's your return on capital employed over here, sir, it's just 9%. Because by investing 10 lakh, your business is giving you 90,000. That's just 9%. Now, if you look at the return on net worth, if you look at the return on net worth figure, that works out to be 63,000 of 10% of 10 lakh. That's 6.3%, because that's 63,000 divided by 10 lakh. In this case, it is 28,000 divided by 5 lakhs, which is 5.6%. And in the other case, it is 7,000 of 2 lakh, which is 3.5%. So these are the three: return on net worth 6.3, 5.6, and 3.5. And over here, you'll find that this takes a lead as compared to the earlier decision or earlier output of 77% in R. So that's what I said. If you want gearing, you need to have a higher degree of speed, and that higher degree of speed is the level of EBIT. So higher level of EBIT will lead to higher amount of return or percentage return flowing to company R. Okay, so that's what we mean by capital gearing. So capital gearing was, as I stated, uh, the ratio of preference share capital and debt to equity share capital reserves subtracted by the fictitious asset. So higher capital gearing means higher risk and you expect higher return, but that higher return is possible only if you have a higher level of EBIT. Okay, are we clear till now, guys? We have done some of the long-term solvency ratios. We have some good number of ratios coming up ahead. So as of now, let's just take a break of 10 minutes and then we can take up more ratios for our calculation. Okay, so someone is asking query as like in this case, in first three ratios, P will be better, but in capital gearing, R is better. So which company is overall better? Return wise, R was better. Return wise, it was R which was better, but obviously R was able to generate that much return by taking a higher risk. So higher capital gearing definitely denotes higher risk also. Without any second thought, there is a higher risk involved in it. Okay. So let's take a break now, guys. Break of 10 minutes. So post break, we'll continue with the subsequent ratios that we need to discuss. Take a break, guys. Welcome back, everyone. Before we went for a break, we discussed the capital gearing ratio, the concept of trading on equity, right? Um, right now, let's go for some more ratios before we begin with any practical problem. Probably practical problems won't be starting today because we have a lot of ratios to cover till now. That'll be done, that'll be possible only after we cover the ratios. So let's look at something called as how to measure the ability to pay the dues on time. Long-term solvency, uh, it should also consider the ability to pay dues on time. Uh, so how do we measure that ability basically? So how are we going to be measuring our ability to pay the dues on time? So for that purpose, let us say there are three persons. X, Y, and Z. I said that this is salary. X has got a salary of 1 lakh. Y is having a salary of 50,000 and Z is having a salary of 60,000. So let us also consider the EMI that they are paying. X is paying an EMI of 20,000. Y is paying an EMI of 20,000. Z is paying an EMI of 20,000. Okay, so EMI is constant and their income is different, right? Or it may be other way around, or it may be a case that all the three numbers, all the three of them are different. So if I ask you, how many times of EMI is salary? So can I say that will be 1 lakh divided by 20,000? That works out to be that works out to be 5 times, right? In case of Y, in case of Y, it is 50,000 divided by 20,000, which is 2.5 times. 60,000 divided by 20,000, it is 3 times. So how many times of EMI is the salary? We find that, sir, for Mr. X, his salary is 5 times of EMI. For Mr. Y, his salary is 2.5 times of his salary. Sorry, his salary is 2.5 times of EMI. For Z, it is 3 times. So if I ask you, out of these three persons, which one would bank be considering more safe? Which one would bank consider safe bet for lending? Where would bank be considering itself safe for providing the funds? Is it X? Is it Y? Or is it Z? Is it X? Is it Y? Or is it Z? Which one of these three would bank consider to be a safe area for loan? Of course, it is X, guys, because it's 5 times, right? Since it is 5 times, bank would consider itself in a safe situation that X is having actually income which is equal to 5 times of his EMI. So that's a safe bet, or that's a better scenario for investor. Okay, so this sort of ratios we are going to look up over here. So your salary for X, salary is covering 5 times of EMI. For Y, the salary is 2.5 times. And for Z, the salary is 3 times. Okay. So interest coverage ratio, preference dividend coverage ratio, fixed charge coverage ratio, and debt service coverage ratio is what we are going to consider the next set of ratios. So interest coverage ratio is calculated as EBIT, that is earnings before interest and tax upon interest. Earnings before interest and tax upon interest. Okay. So what does this ratio mean? This means how many times of interest, it is actually how many times of interest is the EBIT. Because see, company is going to have a income in the form of earnings before interest and tax, and that earnings before interest and tax is used. Earnings before interest and tax is used to pay interest. So your EBIT in comparison to interest, if it is very high, if your EBIT in comparison to interest, if it is very high, it means a safe situation. So we are saying how much interest is being covered by EBIT, or I can say, is EBIT really sufficient to cover interest, right? So of course, this EBIT figure, greater interest coverage ratio means greater safety or greater ability to pay the interest on time. Similarly, if we have this preference dividend coverage ratio, the preference dividend coverage ratio is given as profit after tax, because remember, if you have profit after tax, then only you're going to pay dividend. So that's profit after tax upon preference dividend. So here also it means the same as how many times of preference dividend is the PAT. How many times of preference dividend is the profit after tax? Okay, so both of them are type of coverage ratio which tell us whether we have sufficient income to pay the respective interest or preference dividend. Fixed charge coverage ratio. We have the next fixed charge coverage ratio. Now, the fixed charge coverage ratio is given by earnings before interest and tax. We add back depreciation to it. We add back the depreciation because depreciation is a non-cash expenditure. So EBIT plus depreciation upon interest plus principal due or principal repayment, which simply means we want to know whether the company is having the ability to pay the EMIs on time. Whether the company is having the ability to pay the EMIs on time, because interest and principal, both of them are paid in the form of EMIs. Both of them are paid in the form of EMIs. Okay, so earnings before interest and tax plus depreciation when you do, that's called as EBITDA. This figure, this combined figure is called as earnings before interest, tax, depreciation, and amortization. So when you add back those depreciation, that's your EBITDA. So you want to know how much is your EBITDA in comparison to interest and principal repayment. But obvious, this figure has to be greater than 1 because the numerator, you should be having sufficient cash to pay these expenses, to pay this EMIs. So higher this number, higher the fixed charge coverage number, the better it is. Then we have debt service coverage ratio. Debt service coverage ratio. Debt service coverage ratio is given by earnings available for debt service upon interest plus principal repayment. Now, what is the numerator part, sir? What do you mean by earnings available for debt service? Earnings available for debt service. So over here, this is computed as profit after tax plus interest plus non-cash expenditure plus or minus non-operating items. See, debt service coverage ratio is a measure which tells us what is the sustainable or maintainable cash flow. Maintainable cash flow will be whatever PAT you are earning plus interest plus any non-cash expenses like your depreciation and amortization. And you adjust the non-operating items also, because in profit after tax, you would be having some non-operating items also. Those non-operating items needs to be removed from this figure. If there is any non-operating income, you need to remove it. If there is any non-operating expense, you need to add it back so that you get to know what is the sustainable or maintainable. Because see, non-operating items never recur. Any gain from sale of any property, gain from any sale of any plant, loss on sale of any furniture or PP, all those things are non-operating items, right? So whatever gain or loss you have, or any income from your investment, any income from a short-term investment, those are non-operating items that you cannot maintain it for future. Maintainable cash flows, I can't qualify them to be, right? So therefore, we adjust that and then we consider interest and principal ratio. Okay, so these are the coverage ratios that we have. These are the set of coverage ratios that we have. Interest coverage, which tells you whether you are capable of paying the interest. Preference dividend coverage, which tells you whether you are capable of paying the preference dividend. Fixed charge coverage, which tells you whether you are capable of paying the interest and the principal. And debt service coverage ratio, it's a more refined version of fixed charge coverage, which actually takes into account only those maintainable cash flows which you can use it for paying interest and the principal. That's your EMI. Okay, so that's your set of coverage ratios, which shows your ability. Okay, now, but obvious, apart from the long-term and short-term solvency, we also need to look at the level of activity which the company undertakes, or the efficiency of the company also needs to be checked. We need to also check what is the efficiency of the company. Now, how do we measure whether a company is efficiently utilizing its assets? How do we measure that a company is efficiently utilizing its assets? So we can just consider two cases, company A and B. Let us say both companies are having a sales of 1 lakh. Both of them are having a sales of 1 lakh, right? Both companies A and B are having a sales of 1 lakh, and total assets, we say it is 50,000 and 20,000. Can you tell me which of these two companies are efficiently utilizing those assets that they have? Which of these two companies are efficiently utilizing the assets? Is it company A or is it company B? Which one is utilizing the assets to the best possible extent? Or which company is more efficient in utilizing the assets, or which company is more active in using the assets? Yeah, guys, tell me. Which of these two companies is more efficient? Is it A or B? Company A? Company A or company B? Okay, fine. So here, I would say by investing 50,000 in assets, the company is able to generate 1 lakh sales. By investing 20,000 in assets, the company is able to generate 1 lakh sales. Sir, sales of both companies are same. Investment made by company A in assets is lower. Sales of B are actually 5 times of its assets, whereas sales of A is just 2 times of its assets, right? So we calculate a ratio called as total assets turnover. So this total assets turnover is simply 1 lakh divided by 50,000, which is 2 times. For B, it is 1 lakh divided by 20,000, which is 5 times. 1 lakh divided by 50,000, it is 2 times, and 1 lakh divided by 20,000, that is 5 times. Right? So company B is actually utilizing its assets in a better way because the investment made is less, whereas the sales generated is a higher level. So company B sales are 5 times of its assets, whereas A is just 2 times. So company B is actually able to utilize these assets again and again at a faster pace to generate sales, whereas A is failing in that. Right? So this is total assets turnover, which tells you how efficiently you are utilizing the assets of the company. So now we have some set of ratios, turnover ratios basically, which tell you how efficiently you are utilizing. And obviously, greater the number, the better it is. So coming to the numbers, total asset turnover ratio. So total asset turnover ratio is either sales or COGS. It is either sales or COGS, depending whatever data is available. If COGS data is available, you can definitely use the COGS number. Upon average total assets. Achha, by the way, how do we get this average total assets? So we take opening fixed asset, opening of fixed asset plus current asset plus closing of fixed asset plus current assets opening of fixed asset plus current asset plus closing of fixed asset plus current assets divided by 2, because we are going to take average figures. Okay. Similarly, fixed asset turnover ratio. So since it's fixed asset turnover, we'll say numerator is going to be sales or COGS upon average fixed asset. Now I need not say average fixed asset. How do we compute? It's the opening fixed asset plus closing fixed asset divided by 2. Okay. So now here it tells you this ratio. It tells you how efficiently is the company utilizing its fixed asset. This tells you how efficiently the company is utilizing its overall asset. Capital turnover ratio, which is a net asset turnover, basically. It's also called as net asset turnover. That's computed as sales upon total assets minus current liability. Or you can say it is sales divided by average net assets. And what is net assets, sir? What do you mean by net asset? Net asset is total asset minus current liability. Then current assets turnover ratio, it is, by the way, this is also going to be COGS. Current asset turnover ratio, that's going to be how you are utilizing efficiently your current assets. So sales or COGS divided by average current assets. Working capital turnover, that will be sales or COGS divided by average working capital. Whenever we say average, it's always going to be the first, that is opening plus closing divided by 2. Okay. So if you're given sales and COGS, question will actually specify whether you have to use sales or COGS. If it hasn't been specified, it makes more sense to use COGS. Okay. Or the question will specify. Obviously, if you have only sales figure, then you just need to take the sales figure for computation. Okay. Now we have some interesting ratio for us. Inventory turnover ratio. Let's look at inventory turnover ratio. Suppose we have two companies, A and B. On an average, they keep a stock, average stock of the company. They maintain some average level of stock. Okay. And that average level of stock is, let's say, 3 lakh. on an average, both this company maintain a stock level of 3 lakh. And they are generating a COGS or COGS of 12 lakhs and 15 lakhs. Now, if I ask you, how many times one lot of stock will be sold in a year? Can you tell me how many times one lot of this stock will be sold? Like you have an average stock of 3 lakh and your COGS is 12 lakh. So how many times you need to sell this average stock to reach this level of COGS of 12 lakh? How many times you need to sell this stock of 3 lakh to reach this COGS of 12 lakh? Tell me how many times for A and B. For A and B, how many times? By the way, this ratio is what we call it as stock turnover. And the stock turnover is given as COGS upon average stock. So for A, it is 12 lakhs divided by 3 lakhs, which is 4 times. For B, it is 15 lakhs divided by 3 lakhs, which is 5 times. 4 times and 5 times. So A is 4 times and B is 5 times. So how many times one lot of stock will be sold in a year? That is 4 times for A and 5 times for B. Now, if I ask you which of these two companies are more active in utilizing their average stock, obviously it is B, which is more active. It is the company B, which is more active in utilizing the stock, because with the same level of stock, it is able to generate higher COGS. Now, if I ask you one more question from this, how many months would be required to sell one lot of average stock? Can you tell me how many months would be required to sell one lot of average stock? How many months would be required to sell one lot of average stock? Yeah, guys, tell me. How many months will be required to sell one lot of average stock? Can I say you are selling 4 times in a year? So in a span of 12 months, you are selling 4 times. So each time it is, can I say 3 months? At a gap of 3 months, you are making a sale. One lot of goods you sold it within 3 months. Next lot of goods, you will sell it in another 3 months. Then next lot in another 3 months, and final lot in the last 3 months. Right? So you're going to have each cycle happening in 3 months. And in the second case, this is 12 months divided by 5, which is 2.4 months. 12 months divided by 5, which is 2.4 months. So you have 2.4 months. You're taking 2.4 months to sell one lot of sale, or to sell one lot of stock. Okay. So 2.4 months is what we have as the inventory holding period. This is what stock turnover is. And this ratio is also called as inventory holding period. Right? Sometimes it's also called as inventory velocity. Okay, so just one and the same name. You can also show stock turnover or stock velocity is the another name for this ratio. Stock velocity. Okay, so how many months, if you look at the formula, that's going to be 12 divided by inventory turnover. This is the formula for inventory turnover in terms of months. Okay, in terms of months, we have this. Okay, good. Now, let's go for the next ratio, which is receivables turnover. Receivable turnover, it's basically like if I tell you, sir, we have made, let's say, a credit sales. Suppose we have made a credit sales of 24 lakh. And average debtors is, let's say, 8 lakh. Okay. So if I ask you that average debtors we have in our books as 8 lakh, credit sales is 24 lakh. Can you tell me how many times in a year we will sell goods to debtors? Because on an average, we have 8 lakh as the amount of debtors outstanding. On an average, we have 8 lakh average debtors outstanding. And credit sales is 24 lakh. Credit sales is 24 lakh. So total sales that we have is 24 lakh. Average debtors that we have is 8 lakh. So how many times in a year we would be selling this to debtors? Can I say first lot of debtors 8 lakhs, you make the sales, they remain as debtors in your books. After some time period, you get the money. Again, you make a sale of 8 lakh, you get the money. Again, you make a sale of 8 lakh and get them. So basically, how many times in a year are we going to sell goods to the debtors? This is simply 24 lakh divided by 8 lakh, right? Which is simply 3 times, right? So it's like 3 times, 8 lakh, 8 lakh, 8 lakh. So 3 times you're going to make the sales. The receivables turnover, the formula of receivables turnover is credit sales upon average debtors plus, remember to have average bills receivable also over here, because bills receivable are essentially debtors itself. They are debtors itself, right? So 3 times. Similarly, if I ask you how many months will it take, how many months will it take to collect money from debtors? To collect money from debtors. How many months are we going to take? So in a span of 12 months, you're making 3 times sales. So you are actually having 4 months to collect the money. And that 4 months is what we call it as debtors collection period. 4 months, which is debtors collection period. Okay. Then similarly, we have, just like receivables turnover, we may also have payables turnover ratio. So payables turnover ratio will be credit purchases upon average of creditors plus average of bills payable, right? This tells you how many times in a year you're purchasing goods from the creditors. How many times you are purchasing goods from the creditors. So all these receivables and payables turnover ratio, they indicate the level of activity which the company has. Okay. So that's about the balance sheet ratios. We have covered substantially all the balance sheet based ratios. Now we have to cover some profitability ratios. So how do we go and check, sir, if the company is generating adequate profits or not? How do we get to know whether the company is having a sufficient profit or not? And for that, we have these profitability ratios available. These profitability ratios, they can be based on sales, they can be based on investment, they can be based on return to investor owners, and also based on some market related information. So let's get started with based on sales. Now, gross profit ratio, gross profit ratio, as the name says, gross profit ratio is simply going to be calculated as GP. Gross profit ratio is simply calculated as gross profit upon net sales into 100, because this is based on profits. Gross profit upon net sales into 100. Similarly, net profit ratio will be net profit upon net sales into 100, which tells you what percentage of your sales is gross profit, what percentage of your sales is net profit, and also what percentage of your uh, sales is EBIT. So EBIT upon net sales into 100. Gross profit ratio is GP upon net sales into 100. Net profit ratio is net profit upon net sales into 100. Operating profit is EBIT upon net sales into 100. Okay. So remember, whenever you say operating profit, it's going to be EBIT. Similarly, some of the expenses ratio that we have, expense related ratios. One ratio is something called as COGS ratio. Now, as the name says, it's going to be COGS upon net sales into 100. And remember that COGS is basically 100% minus gross profit ratio, because COGS and gross profit are, they're related to each other, like they're complementary to each other. Similarly, we may have operating ratio. Now, operating ratio means what expenditure do you incur for every 1 rupee of sales that you make. So that's for generating sales, you incur COGS plus operating expense upon net sales. Now, this operating expense means any sort of admin expense, any sort of selling and distribution expense. So COGS plus admin expense plus selling and distribution expense, that's your operating rate. Operating expense ratio. Operating expense ratio is admin plus selling and distribution upon net sales into 100. So there's a difference between operating ratio. In operating ratio, we consider COGS as also as expenditure, whereas in operating expense, we purely consider these two things. Okay. You can also have like finance expense ratio. So finance expense ratio is simply calculated as finance expense upon net sales into 100. So all these profitability ratios are a percentage of sales. They are a percentage of net sales. Okay. Now, how to measure the return that we are generating on investment? The return on investment can be simply said as return upon investments into 100. That's a pretty simple way to calculate whatever return you generate upon investment into 100. Right? Now, return on investment has got three ways of understanding it. On assets, we say what percentage return is earned on assets. Then over here we say what percentage return is earned on capital employed. Then what percentage return is earned on equity shareholders fund. Okay, now we need to look at something called as income statement. Let's have a look at an income statement. How does a typical income statement look like? So income statement obviously starts with a sales figure. It starts with a sales figure, right? So let's say sales of 10 lakh, 10 lakh less variable cost of uh, suppose 5 lakh. So that gives us a contribution of 5 lakh. From that, we subtract EBIT, right? And that EBIT is, sorry, from that we subtract the fixed cost, my bad. Fixed cost, which gives us, let's say, 2 lakh. And we have a earnings before interest and tax as 3 lakh. From this EBIT, we subtract the interest component. So let's say 1 lakh is the interest, and we get profit before tax. From that, we pay the taxes. The profit before tax is, let's say, 2 lakh. 60,000 is the amount of tax that you are paying. And then you have a profit after tax figure of 1,40,000. From this, you pay preference dividend of, let's say, 40,000. Then you have net profit for equity shareholder as 1 lakh. Now, this income, EBIT, this is earned for all investors. So this EBIT is for all investors. Profit after tax figure, this is earned for owners. And this net profit for equity shareholder is actually earned for equity shareholder. So these are basically the income that the company has generated for respective class of investors. EBIT is a holistic figure which tells you that it's for all category of investors. Then for owners, it's 1,40,000, which is the PAT figure, and then this is only for the equity shareholder. Okay, so if we talk of return on asset or return on capital employed or equity shareholder fund, we have all these ratios that we talk of. So first up, return on assets. How much return has the company generated on assets? So it is EBIT which the company has generated on its assets on net assets basically. By investing in net assets include, of course, fixed asset plus current asset less current liability. By investing in this class of assets, the company is earning EBIT. Okay, so the company is earning EBIT, and that's where we say that return on assets is going to be computed like this because EBIT is the income that you generate on assets. Then if I ask you return on capital employed, the return on capital employed is what is the capital employed, right? And what's the return that we get? What's the return that we get on all the capital or on all the investors? Can I say that's EBIT? So EBIT upon total capital employed into 100. And then after tax, it is EBIT into 1 minus tax upon total capital employed into 100. So this is a before tax figure. Before tax, how much return you are generating. And this is a after tax figure. So return on capital employed, it's EBIT upon total capital employed. And before tax, after tax, you're just going to multiply it by 1 minus T. Okay, because to give it after tax effect, 1 minus T. So generally, if it's 30% tax rate, 1 minus 0.3, which becomes 70%. This simply means whatever tax rate is, only the balance is what the investors can take. Okay. And remember, capital employed, total capital employed that we say, it is owned funds plus borrowed funds. And which is essentially the owned funds plus borrowed funds means equity share capital plus preference share capital plus reserve minus any fictitious asset plus borrowings. Okay, that's your return on capital employed. Now, if I ask you return on owned funds, sir, on owned funds means it is profit after tax, because as per our income statement, we stated PAT is what is earned for the owners. So it is return on owned funds will be PAT upon owned funds. And without any prejudice, owned funds means equity share capital plus reserves plus preference share capital minus any fictitious assets. Okay. Similarly, if I ask you what's return on equity, how much return have you generated for the equity? How much return have you generated for the equity shareholders? So for equity shareholders, we know it is the net profit for equity shareholder which matters. It's the net profit for equity shareholders, and therefore return on equity will be calculated as net profit for equity shareholders upon equity shareholders fund. And what do you mean by equity shareholders fund, sir? It means equity share capital plus reserves minus fictitious assets. So these return ratios are basically telling you how much return you have generated for each category of investment. Okay, fine. Now we have some market related ratios. So for that, let me give some information, some numbers. Let us say we are having net profit for equity shareholders as 10 lakh. You are having some number of equity shares, let's say 5 lakh. So if I ask you, sir, what is earnings per share for equity shareholder? For each equity shareholder, how much has the company earned? Can I say, you will say, sir, it is net profit for equity shareholders, net profit for equity shareholders divided by number of equity shares. So that's 10 lakh divided by 5 lakh, which is 2 rupees. Correct? Now, it is 2 rupees. Now, let's say company has declared a dividend. Company has paid a dividend of 6 lakh rupees. So what will be the dividend per share? Can I say it will be dividend paid upon number of equity shares? So dividend paid is 6 lakh. To how many equity shares? To 5 lakh equity shares. So in that case, it is 1.2. That's the dividend per share. Dividend payout ratio. Dividend payout ratio is dividend per share upon earnings per share into 100. Dividend per share upon earnings per share into 100. So dividend per share is 1.2 upon earnings per share is 2 into 100. So dividend per share, it is like 60%. It means whatever is your whatever is your income or whatever is your earning, out of that you are paying out 60%. Out of that you're paying out 60%, because out of 10 lakh you're paying 6 lakh. You can also say 2 is the earnings per share and we are having 1.2 as the DPS. Retention ratio. Retention ratio means 1 minus dividend payout ratio. It simply means if you have paid out 60%, how much have you retained it with yourself? he will say, sir, it is 1 minus 60%, which is 40%. The retention ratio is 40% in our case. Okay. Then we have three more important ratios. First, let's talk of dividend yield earnings, and then we'll come to the price to earning ratio. Let's say a company has a per share earning of 2 rupee. Dividend per share, it was 1.2 as we have seen. Now, market price of the share is let's say rupees 10. So dividend yield, it means an investor who buys the share at 10 rupee, he gets 1.2 as dividend. So what is his percentage return? Can I say 1.2 out of 10? Which is 12%. And this is dividend per share upon market price per share into 100, right? So dividend yield is what percentage return you have as a percentage of market price. Earnings yield is basically EPS upon MPS. That is, a person who buys a share worth 10 rupee, he is going to get an earning of 2 rupee, which translates to 20%. Translates to 20%. So 12% dividend yield and earnings yield is 20%. Now, let's talk about the P ratio. For that, let me just take an example. Two companies are there, X and Y. One is having a earnings per share as 2 rupee. The other company is also having earnings per share of 2 rupee. However, market price of X is 10 and market price of Y is 16. So looking at these figures, company X and Y both have the same earnings, but their market prices are different. Now, can you tell me which of these two companies enjoy a greater confidence of investors? Which of these two companies enjoy a greater confidence of investors? Is it the company X which enjoys a greater confidence, or is it the company Y which enjoys a greater confidence? Which of these two companies enjoy greater confidence of investors? Yeah. Which of these two companies enjoy greater confidence of investors? Is it X or is it Y? Basically, I would like you to ask how many times of EPS is MPS? How many times of EPS is MPS? So basically over here it is 5 times and here it is 8 times, which simply means investors of X are ready to pay 5 times of the earning as a price for the share, and investors of Y are they ready to pay 8 times of the earnings as the price. So which company has a greater confidence of the investors? Because see, wherever you have a confidence, you are ready to pay more for it, right? I'll give you a simple example. On one side, you have Redmi and the other side, you have Apple. Same features, everything same. Same features, same camera style, everything is same. But people are ready to pay more price for Apple products as compared to the Redmi products. Why is it so? Can I say they have more confidence on Apple products as compared to Redmi? They're more confident that this is going to be more reliable, this is going to be of good quality, this is going to be of durable, and therefore people are ready to pay a higher price for Apple, right? Same goes with the company also. Both of them are having the earnings the same, 2 and 2 rupees. But here people are ready to pay more for this because they feel that this earning is sustainable and maybe future growth is there in this company, and therefore they're ready to pay more price for it. Are we getting it? So this ratio that we just computed, market price to earnings per share is what we mean by P ratio, and this is computed as NPS upon EPS, which is simply a company enjoying a higher P means it has got a greater degree of confidence of the investor. So investors have a greater confidence on these companies which have got a higher P ratio. I hope P ratio is crystal clear to everyone. Is the P ratio fundamentally clear? Is the P ratio clear to everyone? Yep. P ratio is clear to everyone. Yeah. So let me see if there are any queries. Yep. Uh, Sir, it is used NPAT is considered instead of EBIT. Just return on assets, you can use EBIT or you can use NPAT. Whenever they say return on assets, it's basically EBIT after tax figure will be same as your net profit after tax. Okay. So you can consider use them interchangeably in after tax consideration. Uh, Vitletwala is asking if sales and POGs both are known to us, it will be more appropriate figure to find asset turnover. It should be, I think I have answered this. It should be the POGs, which should be enjoying your priority. Vinay is asking, is the numerator of the fixed charge coverage ratio and the debt service coverage ratio same? Numerator of fixed charge and debt service coverage, uh, there is a slight difference. I will let you know. Yeah. So in this fixed charge coverage ratio, we are just adding back the depreciation portion, and we are not subtracting or adjusting the non-operating items. In debt service coverage ratio, we are adjusting the non-operating items also. Is EBITDA and EBIT one and the same? No, EBITDA is, as I have stated, EBIT plus depreciation will make it as EBITDA. Okay. Josh is asking, is sir, isn't lower P considered better? No, Josh. Lower P is not considered better. It's not a single measure of confidence. Rather, higher P means higher confidence of the shareholders. If the company deserves to be having more confidence and it is having lesser confidence, in that scenario, lower P is an investment opportunity for you. For example, if I tell you there are class of companies. There is an industry which enjoys a PE of 8 times, but whereas there is a company which has a PE of 6 times. So you should actually inquire into why this company is having lower P as compared to the overall industry. As compared to the overall industry, why is this company having lower P? If it is having a lower P, if it is having lower P for due to you know uh, some inherent limitations of that company itself or some disadvantage of the company, then it is okay. It means it's a genuine thing. But in spite of company being fundamentally strong, if it is enjoying lower P, it means it's a hidden gem in your investment portfolio. You should buy this stock because in any point of time, going ahead in future, this is going to outshine and that's going to give a greater return for you. Okay, Hani Agarwal is asking return on asset टैक्स इफेक्ट कंसीडर करेंगे रिटर्न ऑन एसेट्स में टैक्स इफेक्ट कंसीडर करेंगे यस if it is after tax if the question asks you for after tax you need to consider it as after tax figure okay any other queries let me just see okay there aren't any queries as such MCQs not MCQs on this we'll have practice questions which I have uploaded
you, if you So not on MCQ, but we'll have practice question. Generally, how many marks question come in the exams from this chapter? See, this is a professional exam, so you can't be very sure about how many marks. But yes, you have a question from each of the chapter. Okay, clear everyone? Fundamentally, everything is clear. So from next class that we have on Saturday, we'll actually start with questions of the handout that I have uploaded on the portal. So we'll solve questions from that handout in the next class. Okay, guys. So with that, let's just stop here for the day. It is running short of time, so we'll stop here for the day. See you in the next class, guys. Till then, bye bye and take care.